What's up, guys? Hey, it's Ryan Lee here. I want to share another quick video with you with the financial freedom formula. Guys, I was at a conference a couple weeks ago with one of the greatest CPAs of all time, Tom Wheelwrights. And now, before you shut this off, I know I'm talking about taxes, but guys, this is going to be, and quite literally is, the number one expense in your life, right? It's taxes. And Tom Wheelwright, what he shared in this seminar is that the difference between the wealthy and the middle class, the difference between those who have and those who don't, is their ability to understand their greatest expense and how to eliminate that and minimize that as much as possible, which is tax. So the Wall Street Journal not too long ago came out with an article, and they called what I'm going to share with you the tax shelter of the rich. Now, by the way, if you want a copy of everything that I'm sharing with you, along with a format of how to do all of this in your financial plan, text cash flow to 797979, cash flow to 797979. This is the financial freedom formula. And really what the Wall Street Journal, what they call the tax shelter of the rich, is if we just look at the tax system, there are basically three places you can put your money, right? If you think about it, you can take your money and you can put it into a taxable bucket, and you will pay taxes as you go, right? So you make some money, you pay taxes. And then next year you make some more money, you pay taxes. Now this can go for your investing as well. Making money in mutual funds and things like that aren't in tax deferred accounts, you pay taxes on your gains as you go. If you decide not to do that, and if you decide to follow traditional advice, you can put your money into a tax deferred bucket, right? And you will pay taxes in the future on everything you put in plus all of the interest that you earn, right? So where do most people put their retirement savings? In 401ks, IRAs, tax-deferred vehicles, because your CPA, who is not Tom Wheelwright, is telling you that you'll retire in a lower tax bracket. Now, I want to just ask you one question. If taxes stay the same as they are today, and there's a big argument to say that they will go up, but even if they stay the same as they are today, if you retire in a lower tax bracket, what does that mean? Right? What does that mean? That means quite literally you retire with less income than you have today. Now, when you think about retirement, does your dream of retirement have to do with you living on less than you live on today? Now, granted, you might not be working, right? You might not have some of the expenses associated with working, but at the flip side, you'll have additional expenses that you have been deferring to the future. You know, the travel that you want to take. You want to spend more time with your family, your grandkids, all the bucket list places you want to go. It's likely that at the very least you'll have the same lifestyle. And if we factor in the cost of living going up with inflation, if you retire in a lower tax bracket, which is what your CPA is telling you that will happen when you use a 401k, you retire poorer than you are today. So this is where most people put their retirement savings, in the tax deferred bucket, 401ks, IRAs, that kind of stuff. Now, if you want to retire like the rich, and invest and use money like the rich, then you need to consider that you need to be using the tax-free bucket. Now, we're going to talk more about this, but I want to ask you one question before we go to this. The tax shelter of the rich. I'm going to ask you a question of what is an asset. Now, if any of you have read the book Rich Dad, Poor Dad, in this book, he talks about an asset as anything that produces cash flow. Right? So if we think about your 401k or any other investment tool that you're using, it's anything that produces income. And so only when we understand how those assets produce income, like your 401k, can we really determine how effective of an asset it is. And the challenge with that is you've shifted in a 401k your biggest liability, which is we have no idea how much income a 401k will produce you, right? Because we don't know what the tax code is. But I want to go one step further with this. What is the greatest asset in your life? If you think of all of the property value that you have, your home, your assets, your 401k, your rental real estate, whatever it is you have, if you think of all of these things, what is at the foundation and the source of you having been able to create all of these assets? Your number one asset is you, right? So if we think about this, what should we do with our number one asset? We want to protect our assets. Think about your car. Think about your home. Think about all the things that you cherish and value. Most of the time, you want to have insurance on those things, right? Think about your car. If you didn't have insurance and you were driving down the highway without insurance, how would you feel? Would you be scared or nervous, right? You probably would. If you did have insurance, it's not like you want to get in a car accident, but you've already prepared for that with insurance. And so you can focus on more profitable, productive things like listening to a podcast or, listening to music, right? Or enjoying the scenery. But the middle class, primarily the way they think of life insurance, they think of life insurance as an expense, right? They don't really think of themselves as the number one asset. And so they try to buy the cheapest, most, cheapest type of insurance as possible. And this is term insurance. And it's simply a matter of ignorance. They don't know how life insurance can work. But the wealthy predominantly think of themselves as the number one asset, and they think of life insurance, again, as an asset. And the reason the wealthy think of life insurance as an asset is because they understand the rules, right? They don't have ignorance. They've spent enough time to understand the rules of the tax code, knowing that if they can minimize tax as much as possible, and life insurance is one of those tools to do that, they can actually keep more of their money. So if we go back up here, in the tax-free bucket, there are only 3 places you can put your money. That's it. That is it. There are only 3 places. You can put your money into a Roth IRA, you can put your money into municipal government bonds, or you can put your money into life insurance. Now, most people, when they think of life insurance, they think about it from a middle class standpoint, and they try to buy as little life insurance for the lowest expense that absolutely possible. The wealthy think of life insurance as an asset, and the reason it's an asset, again, is how does it produce cash flow? They set it up in a very specific way. So what if you had a life insurance policy that acted and looked like a vault, right? When you think about a vault, what does a vault have? It has some very unique characteristics. What if you could build a life insurance policy that would allow you to earn a guaranteed rate of return on your money? Okay, now what if you were able to put money into a life insurance policy and treat it kind of like a savings account, like a bank account, like an investment, a place to store your cash, right? And once your cash was stored in this life insurance policy, you could actually earn a guaranteed rate of return on it. In addition to that, you could earn a dividend on it every single year. Now, think about this. What level of confidence and certainty would come into your life if you actually had a place in the uncertainty of the world that we live in today where you could actually earn a guaranteed rate of return and a dividend every single year for the rest of your life? For the rest of your life. This foundation would set you up to do some amazing things if you knew that your money was always compounding. And the next thing, what if your money was 100% safe and private, right? If it was backed up by a guaranteed contract by companies who have been doing this for hundreds, I said that plural, hundreds of years, and because we use life insurance, all of the growth that you're getting on your vault-like account is coming back to you tax-free. And remember Rich Dad's formula, right? His formula is anything that, an asset is anything that produces cash flow. What if the cash inside of your account, what if you could actually use and leverage that money today and still be able to get growth on that money at the same time? Would that change your life a little bit? I know for me it's changed my life, and the clients that I work with, it changes their lives as well. They can literally take their money and accomplish multiple goals with their money. They can achieve short-term goals, buying rental real estate, running their business, putting their kids through college, you name it. They can achieve long-term goals and having their money grow and produce a stream of income tax-free to them in the future, right? This is exactly how it works. Now, if you don't believe me, there are many, many wealthy individuals, you can Google this, who store tons of their money, a lot of their money in life insurance, right? From presidents, from politicians to wealthy individuals. Lots of people put their money in life insurance, and it's the people who understand the principles of being wealthy, the people that understand they are the number one asset. In addition to having a death benefit in their policy, they get to treat their policy like a bank, like a vault, and use the cash flow of their money today, right? Now, it falls within line of the tax-free vehicle, the tax-free bucket, so everything that they're getting in this policy grows tax-free. Now, I want to prove one last thing to you, okay? Now, before I go to this, in fact, here's what I'm going to do. I'm going to bring up one calculator here. And I want to share with you why the wealthy, why the tax code is written for the wealthy, okay? In Tom Wheelwright's presentation, he talked a lot about 99% of the tax code is written for the wealthy. It's not written for the average everyday person. It's written for the wealthy. And here's the reason why. The IRS, they use the tax code as a way to incentivize behavior. They want you, they want me, they want all of us to do certain things, and they use the tax code as a way to incentivize that. So to prove this out, I'm going to show you just a little example here, okay? So in this example, I'm going to show you how powerful the tax code actually is and how the IRS actually wants you to pay less in taxes because it incentivizes economic growth and movement, okay? So here we go. You inherit $100,000. Let's say your great Aunt Millie dies and you get $100,000. But part of your inheritance is the fact that you have to keep this $100,000 invested and create a future legacy for great Aunt Millie's, future generations, okay? So $100,000, you invest it, and you're going to earn a 10% rate of return. And we're going to keep this money invested for 100 years. Okay, what you'll notice, $100,000 earning 10% rate of return earns you $10,000 interest, bumping your value to $110,000. So next year you earn $10,000 again, or excuse me, 10% on $110,000, you earn $11,000 interest, and thus the compounding starts. And you'll notice that your balance gets bigger every single year. Every single year, it's getting a lot bigger, a lot bigger, a lot bigger. You're up to, multiple millions of dollars now. And right here in year 97, you cross the $1 billion mark, right? You go from 941 million to $1 billion, okay? And at the end of this 100-year example, we have $1.3 billion. So $100,000 earning 10% over 100 years compounds to $1.3 billion. Now, what happens if we introduce taxes into this equation, okay? What if every single year you have to pay 30% in taxes as you go, okay? What you'll notice is your $10,000 earning in the first year is taxed by 30%, so you lose $3,000 to the tax man. So now you're only compounding at $107,000 next year. So you'll notice everything gets smaller. We were going to be at $1.3 billion. Now with a 30% tax rate, the IRS over this 100-year period of time, they actually get to collect their sum of money, which is $37 million in taxes, and you go from having $1.3 billion down to having $86 million. Now, not bad, right? $86 million. But let me ask you this question. What if the IRS raised their tax rates, right? What if they taxed you heavier and higher? Would their tax revenue, their total revenue that they collect, go up or down? Now, most people would think, well, if we go from 30% to 40%, that the IRS is going to collect more in taxes. Let's just do the math here. If the IRS collects more in taxes and they charge you more in taxes, 40% tax rate, they charge you more in the beginning, right? You now have less that you're compounding with, so you earn less all the way throughout. But notice this, at 30%, we were going to be taxed at $37 million. $37 million would have been lost in taxes. If we go to 40%, the IRS only collects $22 million in this entire transaction. $22 million. Now your balance went from $80 million down to $33 million, but the IRS actually lost money, right? Because they tax you at a higher rate, they lost money. And the reason for that, the more you earn, the more they earn. The less you earn, the less they earn. So what if we bumped our tax rate down to 20%? Okay, 20%. Boom, look at that. The IRS just went back up. Now, over this 100-year period of time, they earned $54 million, but you walked away with $219 million. $219 million, the IRS gets 54. What if they knocked it down to 10%? Right? The IRS just collected $61 million in revenue, and you walked away with $552 million. What if we knock this up to 80%? Well, the IRS over this period of time collects $2 million in revenue. So the more they tax, the less they have. The more they tax, the less they have. Now, I want to come back to this, guys, and tell you one more time, right? The IRS uses the tax code as a way to incentivize behavior. They want you to move your money. They want you to use your money. They want you to be active in the economy, because every time a dollar moves, they get to tax it all throughout its movement, right? Think about this. When you have a dollar that you go out and spend, that dollar has been taxed. Then when you go out and spend it, you get to pay taxes on it again when you spend it, whether you're at the gas pump or a grocery store. Then when the person that you gave the money to gets to have that dollar, they have to pay taxes on it, and then they go spend it and pay taxes on it again. And so the tax code incentivizes you to move your money. The IRS actually makes more money when you move your money. Now, at the same time, they incentivize you to use the tax code to your advantage, meaning they don't want you to pay more in taxes. They want you to pay less in taxes, so you're incentivized to move your money. And what they do is they use the tax code as a way to say, look, guys, put your money in these locations. The rich use the IRS as a tax shelter. They use it as a tax shelter. And what their goal is to move their money as much as possible and then protect it in places like this, where from that point on, it grows tax-free. So I want to give you one last piece of information, and I want to tell you that the banks, the rich, the wealthy, all that stuff, they're telling you one thing, but they're doing the exact opposite. Here's just yet another example. Bank of America, where do they keep all their money? Well, they keep billions, $137 billion in cash value life insurance. JP Morgan Chase, $112 billion in cash value life insurance. Wells Fargo, $81 billion, and the list goes on and on. The corporations, the wealthy, the people who understand how the tax code works, they use the tax code as a tax shelter. They use the tax code because 99% of it is written to tell them how to not pay taxes or as little taxes as possible. And the more they follow the code, the more the IRS makes. The more the IRS makes, the more you make, right? So guys, here's the bottom line. If you're not following the IRS code to save and protect on taxes, then you're missing the boat. You're following tax strategies of the middle class, thinking that life insurance is an expense, buying term insurance, keeping your money stagnant in a 401k, hoping that you retire in a lower tax bracket. That is not, that does not, that will never work. All right, so all that being said, guys, text cash flow to 797979, and that's going to take you to it's going to send you a text message where you can actually download a book. And that book looks like this. Let me open it up. Cash Flow Tactics. All right, it looks like this, right? So you can actually download this book right here. The 0% Retirement book, right? And this book, here's the picture. It is a step-by-step guide to show you how to eliminate taxes from your retirement plan, how to use cash value life insurance, use the vault, use accounts that banks and wealthy individuals are using to eliminate taxes from your future. All right, hope you guys do it. Cash flow to 797979. Have a great day, guys.